India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on another fresh new edition of Bazaar Morning Call. It's a Thursday morning. We're coming to you as always from the CNBC-TV18 Motilal Oswal studios. And it's an exciting day with lots of news flow to track, to sort of react to this morning. And we will discuss all of that in great detail here over the next few hours. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, hi, good morning.
Hi, good morning. So I guess, the Fed didn't deliver as one would have hoped, but the market still rallied. And I think that's been the interesting facet of the overnight action. We'll talk about it.
We were talking about this yesterday. Powell likes to just look through everything.
Yeah.
Jo kuch bhi aaye, aage dekho. The first move is going to be a cut. I mean, not really bothered about hotter than expected data or anything of that sort.
Well, that's right. So we make a fresh all-time high today yet again.
Yeah.
And let's see where we go from there, because last few sessions we've been moving to those fresh all-time highs but unable to hold out there. Maybe today's the day.
Yeah, absolutely. And I think for the Nifty Bank as well, let's see, because the Nifty Bank, so Nifty has made new highs. Nifty Bank has struggled. It's not been able to take out the last highs. So let's see. Well, let's just start at the very beginning, right? As we begin a new session, an important one, and tell you what you need to know in a trade today. So you essentially have three things. You have CPI numbers, the US consumer price inflation numbers which came. They were soft. FOMC followed, and that was confusing. I will explain why. But the market signal was pretty clear. Now, the market signal, which is the yield, the bond yield, is reacting to the CPI. I'm not sure how much it reacted to the FOMC. The yield was down 8 basis points. Actually, across the curve, 2, 5, 10, 30, yields were lower by between 7 and 8 basis points. So let's start with the first cue, which is the CPI number, which was softer than expected. The actual has come in at 0.16. Expectation was 0.2. The last number in April was 0.3. So this is a nice progression, exactly what you want, right? Immaculate disinflation, as some have called it. Now, equities were strong, and this is in reaction because, the FOMC happened much later. Markets had opened, and they rallied. The S&P was up 0.85. This is, of course, by close. NASDAQ was up about 1.5% as well, largely at the day's high for equities. You then had bond yields, which fell sharply, as I said. The 10-year was down 8 basis points from 4.5 very recently. Remember, the labor market data was very strong. On Monday, we saw that 15 basis point move higher, which took us to about 4.47. And now we're back at 4.32 with the last 2 days fall. Dollar index also pulled back a little bit. We're down about 0.5% to about 104.7. Now, both yields and dollar, the reaction to the FOMC, which came in through the yields and dollar, both actually ticked slightly higher from the day's low. Yields and dollar would have been even lower had it not been for the Fed. And what did the Fed do? They basically signaled just one cut in 2024 as opposed to 3, which they signaled in May, right? And this is the dot plot. Basically forecasts in terms of what all FOMC voting members are really saying. So 25 basis point cut in 2024 as opposed to 75, which they saw in May. Now, the cumulative amount of cuts through 2024 between now and 2026, because they put out forecasts not just for 24, but 25 and 26 as well, that remains unchanged at 225 basis points, 9 cuts in total. But what they're essentially saying is this year, we'll only perhaps get 1. That is what they're saying now. It may change, but what they're saying is, so the cuts, the majority of the cuts are going to be bunched up into 25 and 26, but cumulatively, when you compare what they said in the last meeting and now it's unchanged, 225 basis points is what they are still saying. Now, this is the interesting thing, and this is why I use that word confusing, right? Powell essentially, because these consumer price and inflation numbers had come, naturally, the decision has been made. There were questions in the press conference as to how much of the softer inflation number is an input into the data making that you've seen today. And this is essentially what he said. He said most officials did not incorporate latest CPI readings in their economic projections and dots. Now, what does that mean? Does that mean that the latest Fed decision, in a way, is not marked to market, marked to the latest CPI data? We will Fed officials all love to speak, right? We will hear a lot of them actually going on the record and talking to sort of media, news channels, etc. over the next couple of weeks. So is this final, or will what we've heard overnight move basis the CPI number, which Powell himself has said that many have not really taken note of and have not incorporated into the projections which they said yesterday. And that's basically why I said maybe at the margin a little confusing. But in any case, overall, I think it's still a largely positive, not as dovish as the last two times, but it's not hawkish either. So it's somewhere there. But the fact is the data, which is the primary driver for the Fed, has come in. The CPI data has come in softer than expectations, and the market signal for us is pretty good. So all of that kind of now gets us to where we are as far as the market indices here are concerned. The Nifty yesterday broke above the previous high, which is 23,411, but it could not close above it. We pulled back, like we've seen day before yesterday as well. At about 3 o'clock, the selling pressure came, but we ended higher on a day-on-day basis. The high that we hit on the Nifty is 23,442, and that becomes the first level for the market to take. That'll go. I mean, right at the word go, at the word open. Nifty, the daily upper Bollinger Band for the Nifty is 23,526. That's the first target, which the Nifty now needs to sort of stay above. We will, I think, open above that particular level or around there, and then we've got to stay above it. On the way down, supports come in at the hourly averages, 23,150. For the Nifty Bank, targets are still the all-time highs, which is 51,133. There is one intermediate high before that, which the Bank Nifty has been unsuccessful in taking out. So let's see if we've got enough there today. And supports there come in at 49,625. Immediate, that's the hourly support. And then, of course, the 20-day moving average, which comes in a little later. But I think as the GIFT Nifty is indicating, it'll come up on your screen. We're looking up rather than down this morning, at least at the word go. It's a positive handoff from Wall Street, what we've seen, especially with the softer than expected consumer price inflation data. Surabhi.
Oh, yeah, absolutely. And the yields in the US, Prashant, they're moving like stocks, right? I mean, 8-9 basis points on a daily basis. It's been really all over the place, very dramatic moves in the US bond market. Just to add to what Prashant said, I guess yesterday the market took heart from the fact that the statement itself did say that in recent months, inflation is, showing modest further progress towards Fed's 2% inflation target. That was one. And the other, so you were talking about, whether the Fed yesterday took note of yesterday's print or not. Yeah. I was, reading the comments coming in from the press conference as well. And I just want to put this one up. We see today's report as progress and, as you know, building confidence. But then there was a but. There's always a but when Fed officials are speaking, right? But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. So they acknowledge that today's report is building confidence. But they think it'll take a while. So I think that's what translated into that 1 this year and now 4 next year, perhaps. Absolutely. Okay, let's talk about data back at home as well, because, that was actually presenting a very good picture. We've got a double bonanza in terms of macros here back at home. So the CPI number, that's come in lower than estimates, and the IIP number is above estimates. CPI inflation coming down to 4.75%. The poll was 4.9%. It's also lower month on month. So it's lower than the poll, lower than the previous month. That's good news. The only problem is food inflation. That's very, very sticky. It's refusing to go down. Still at around the 8.7% mark. It's practically unchanged from last month. So that's one problem point. On IIP, we're at 5% for the month gone by. The estimate was 4.9%, and 5% is slightly better, one notch better than the 4.9% of the previous month. So IIP is better than expectations. Inflation is lower than expectations, but not food. So that's the sum and substance of the macro releases that we had last evening here. In terms of flows, the net numbers are very quiet. I mean, hardly anything really. FII is positive about 400 odd crores. DII is positive about 200 crores. So the net numbers are not sort of saying too much. This week has been all about the broader market. So I thought I'll just put the week's tally so far, 3 days so far. Look at what's happening in the small cap and the mid cap arena. Small cap index is up 3.5% already. Mid cap index up 2%. The Nifty and the Bank Nifty are flat. Basically, it's telling us that I think after the mega event, the volatility, the interest has really truly shifted back to the broader arena. And we'll see if there's more of the same, because the pattern, Nigel, last couple of days is you hit that all-time high, you cool off by afternoon, and the action remains on individual stocks.
Well, that's right. And I think more of the same is likely to continue. And today the scene is perfectly set up. If the Nifty needs to go ahead and conquer that hump, then today could be the day. But let's run you through the cues then. Today is the weekly expiry as well. So it adds a bit more of spice to the trading session, because today you'll have the Nifty that will move around, particularly in the final hour of trade. So that's something that we could track. In terms of global cues, the yields are softer. The dollar index is lower than what we saw yesterday. So that serves as a bit of a tailwind for us, as we have seen in the past. Yes, it's bounced off a little bit from the low, but I'll say that's good. So favorable US data, favorable India economic data as well. That bodes well for our markets. Moving to the levels that I'm looking at, on the Nifty, we're going to around that 23,450 odd mark as we have seen the last few days, and we're finding resistance out there. And all the three last few sessions, well, we have been coming off the top. Even if you look at the Nifty Bank, 50,250, 50,300, that's a bit of a resistance zone on that one. So 50,250 and on the Nifty, 23,450, both those two are going to be crucial levels. So let's see if we can get past that. What did the FIs do in the F&O market? Well, they added some long positions. 20,000 contracts is what they added. Shorts, they unwound close to around 25,000 contracts on. And that's why now the short positioning from more than 85%, it's come down to around 59%. And if you pull up the bar chart, this is giving you a perfect analysis in terms of what's been going on. The FI's net short was around 3.5 lakh contracts. Currently, it's come down to around 80,000 contracts. So the short positions have been cut by close to around a fourth. Even if you look at the client positioning, they had 3 lakh contracts on the long side. And from there, in fact, that's come down to around 60,000 contracts on the long side. So they as well have cut their long positioning by close to around a fourth out there. Moving to, the levels that we're looking at, the 23,400 call, that's been seeing a fair bit of open interest build up. Yesterday as well, the premium did come in lower. The rough premium that you're looking at, there is around 130 rupees odd. So you plug in the numbers. Resistance comes in at around 23,475. Just plugging in that number, rough number of around 120. Yesterday, the high point of the day as well, it was around those levels. So that's the crucial resistance zone you're looking at. On the downside, going by the options data, that's a support zone. If that breaks, then in fact, you're looking at the 20 DMA. I don't think we'll visit these support zones, but resistance, this is important that we get past this particular level. Now, in terms of sectors that I'm looking at today, normally when you have the Fed outcome and it's pretty much okay, two sectors are normally in focus, the IT and the metal index. Yesterday, the IT index came off the high point of the day. So those are the sectors to watch. And the stock to watch today, I think, will be L&T Finance Holdings because that large block goes out of the way. It's a clean out trade. So I'll keep an eye out on this stock. It could very well be the stock of the day, given that the discount is less than 1%. So that's the one that I'm tracking today.
Okay, all right. Nigel, thanks very much for that. Let's kick it off then with the equity call of the morning. Indranil Sengupta of CLSA says the Fed has turned hawkish despite May core CPI inflation surprising down at 0.2%. He says Fed's dot plot has cut down 2024 rate cuts from 75 basis points to just 25 basis points and raised the 2025 cuts from 75 bips to a whole 100 bips. He says their economists still see two Fed rate cuts on November 7 and December 18 in 2024 itself. Given the Fed uncertainty, he retains his first RBI rate cut on October 9. Indranil says he continues to see 100 basis points of cuts by June 2025 and says he worries the real RBI repo rate at 1.8% now is much higher than the 1% deemed neutral, and this is already pulling down real GVA growth. He says given the Fed's higher for longer stance, he expects the Union Budget 2024 to provide interest rate subvention to vulnerable sectors.
Okay, so money market views here now. We've got Parul Mittal of Standard Chartered Bank, who says that the USD INR inched higher during the week on dollar strength and higher imported demand. She says intervention by local banks helps smoothen volatility. She goes on to say that external events driving US dollar moves remain key rupee drivers in the near term. However, she expects the USD INR to trade in a narrow range between 83.3 to 83.75 to the dollar in the near term, driven by intervention by local banks on either side. Parul says a break above 83.75 to the dollar can take the USD INR to 84 levels now.
On bonds, Parul says after a knee-jerk reaction to the election surprise and concerns on deviation from fiscal deficit targets, government bonds stabilize as smooth government formation raised conviction on adherence to fiscal targets. She says India MPC was on expected lines with the dovish hint as an additional MPC member voted for a cut. In the near term, she says Indian market is likely to draw cues from global interest rate movements. She says FPI inflows in government bonds remain positive as inclusion into a major global bond index kicks in from the end of this month. She expects the 10-year benchmark bond yield to trade in a band of 6.95 to 7.1% in the near term.
Well, a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, we run you through the list. We look at L&T Finance, Nestle India, Shoba, Dr. Reddy's Laboratories, Gensol Engineering, and Bondada Engineering. They won an order, so we'll keep an eye out on that one. On the flip side, life insurers, PTC India Financial Services, and Arvind will be reacting to negative news flow.
Okay, well, Nathan Sheets is with us. He's Global Chief Economist at Citi. Is the big man here to weigh in on the rates. Mr. Sheets, great to have you with us here. Good morning. Thanks for your time. Prashant this side. So, what's the message from the Fed? Is it a little confusing at the margin? Or is it dovish? I mean, it's all relative, of course, because last two meetings, the Fed sounded dovish, even though the data that they were sort of coming into those particular meetings was soft. Hot. The labor market data especially. So this time as well, have they looked through it, or are they kind of now more data dependent in that sense? What did you make of it?
I think there were a lot of moving parts today. As you pointed out previously, the soft CPI number was very important. And I think that was dominant in the market response. And that was operating in the background of Powell's comments. So Powell presented his dot plot and said, look, our committee's central tendency at the moment is one cut. But he hardly fell on his sword about it. He emphasized it was a conservative approach. And I really do agree with you that bottom line, what you're hearing from the Fed, what you're hearing from Jay Powell, is they're going to be data dependent. They're going to be empirically driven. And if we get a couple more months of inflation, like we saw this morning, the Fed's going to be cutting rates. And my sense is that very well may happen as soon as September.
Hi, Mr. Sheets. Good morning. Great to have you with us on the show today. So what do you make of the market's reaction? Because clearly the market hasn't been perturbed that rate cuts have been pushed into 2025. Look at the equity market. Continues to make all-time highs on a daily basis. Is this kind of a setup likely to continue? The market seems to have digested this whole pushback rather well.
I think the markets were focused on the CPI print. And I think the broad view is that some of the hotter inflation we had earlier in the year is breaking. And given that, I think that the expectation, as I mentioned, is that the Fed is going to be data-driven, and that's going to open the door for more rate cuts than were in the SEP. So in some sense, I think you can say that the markets were looking through the SEP and downweighting it based on their expectations that we are seeing some improvement in inflation that was not fully factored into those projections.
Good morning, Mr. Sheets, and thanks a lot for joining in on the show. This is Nigel on this side. This is the first time we're speaking post the election results here in India. You had indicated that, yes, the stock markets would prefer continuity because they're familiar with the Modi-led government. What do you make of it now? It's a coalition government. It still appears favorable from a stock market perspective, but I wanted your comment on that one. And also, any comment on the Indian Central Bank? The RBI is in a bit of a Goldilocks scenario, right? Our inflation is cooling. We have growth as well that's fairly stable. So your view on that?
So on the RBI, when you're in those kind of Goldilocks scenarios where inflation cools and growth is solid, that's a place where central banks can be gradual, they can be measured, they can pay attention and wait for something to change. It's kind of an ideal scenario for central bankers. Excuse me. On the election, I think that the number one issue there and the number one takeaway for global investors is that Modi is equivalent to continuity. And broadly speaking, global investors are aware of and comfortable with the investment regime and know how to invest in India. We've certainly seen that over the last several years. And then, as you point out, I think the question is, on the margins, are policies going to be changing in some way because it's a coalition government that might have an effect on either the ability to invest or the attractiveness of investment in India? And I think those are the open questions. But for now, based on where the equity market is, I think investors are giving Modi the benefit of the doubt.
Mr. Sheets, just a quick point that that googly, which Mr. Powell yesterday, just to go back to the Fed, which he threw in, right? He said that, well, maybe the forecasts, the dot plots, etc., don't incorporate this softer CPI data. I mean, is it really possible? Because you get the data in the morning, the decision is in the evening, so you can always sort of make some changes and take out a fresh printout. You think? Yeah, sorry, go on.
I think Powell was a little vague in his response on that one, and maybe purposely so. But the way I interpret what he was saying is that in the face of the data that they received, that some of the members of the committee felt that the new information was sufficiently significant that they went ahead and changed some features of their forecast. Well, a number of other members of the committee said, 1 month of inflation is not going to dramatically change either my forecast or my expectations for policy. And frankly, we need to be in a world where expectations for the Fed and Fed policy isn't being pushed around by one data point, plus or minus where it lands. But I think everyone on the committee had an opportunity to revise. Some felt it was necessary, others didn't. So I'm not sure I'd play up the staleness of the SEP so much as he said it was conservative, and we'll see if the data justify a more vigorous approach, as I think they will.
All right, Mr. Sheets, we will leave it on that note. A little shorter chat today, but we look forward to a longer one next time. Thank you very much for your views over there. Need to take a very quick break. Come back on the other side with our list of top stocks to watch out for this Thursday morning. Welcome back. Well, let's get to the stock list of the morning, all the buzzing stocks that you need to be aware of. We've got our team standing by with the CNBC-TV18 list of top stocks to watch. Guys, great to have all of you. Vivek, let's start with L&T Finance. What's the update here?
Well, good morning. So L&T Finance holding along expected lines, something that Nimesh had also been mentioning as far as his D3 chatter was concerned. There's a large block deal that's anticipated in today's trade. Now, the sellers are going to be Bain Capital affiliates, which is BC Asia Investment as well as BC Asia Growth. Along with that, a few P-note funds, under the name of BNP Paribas Financial SNC will also be pairing their stake. Now, this particular block deal is a complete clean-out trade. So, total 3.5% of equity is expected to change hands, and the discount is less than 1%. That raises hopes that this particular block deal will happen in the block window itself. The total deal size at the base price is more than 1,500 crores. So, it will be important to see how L&T Finance reacts after going with the green, because the overhang will go through, and anticipating this particular deal to happen in the block window.
Okay, well, Vivek, thank you very much for that. So the spate of block deals, it's only picking up pace, and we'll sort of get you more as we go along. But Sobha should be in focus today as well. Sonal is here with details. Sonal, morning.
Good morning, Prashant. Well, Sobha will be in focus because the board has approved raising funds up to 2,000 crore rupees, and this is via rights issue. The issue price is set at 1,651 rupees a share. Remember, this is a 20% discount to yesterday's closing market price as well. The proposed issuance will be of around 12.1 million shares, and this could lead to a post-issue equity dilution of 11.3%. If we talk about the number in terms of application, 825.5 rupees per share, that is payable on application, and the remaining amount, that is the equivalent amount, can be paid in not more than 2 subsequent calls. Now, the company says the entire process that should be completed by 31st December 2025, and the entitlement ratio is 6:47. So it's a growth capital that the company is planning to raise. So going with green on the stock today.
Okay, all right, Sonal, thanks a lot for that one. Mangalam joins us because there's good news coming in for Nestle. Mangalam, tell us more, the royalty issue behind them and things looking up.
Well, things looking up for Nestle. It's a sentiment positive, actually, because, the Nestle board has told the exchanges, rather the company has told the exchanges that the board is approved payment of royalty at 4.5% to the parent for the next 5 years. And that is something that was anticipated because this amount was unchanged. The original proposal of increasing the royalty from 4.5% to about 5.25% over the next 5 years was earlier rejected by shareholders. So obviously the street believed that, now this issue would be put to rest, and that's exactly what has happened. So that's a sentiment positive. Additionally, there's also an upgrade coming in from CLSA this morning. So that should further boost the stock. See it in green today.
All right, Mangalam, thanks very much for that. Nestle in focus. Back to Vivek. He's watching out for some more names, including PTC India, PTC Finance, as well as Dr. Reddy's. Vivek?
Well, that's right. So 2 stocks on my radar, expect both of them to open in the red. First one is PTC India and its subsidiary PTC India Financial Services. PTC India Financial Services, has had trouble with the regulators for quite some time. And yesterday, SEBI, has gone ahead and passed order as far as the matter in PTC India Financial Services is concerned. So they've gone ahead and barred Pawan Singh, the ex-MD over there, and has fined him 25 lakhs and has also barred him from holding any director's post in a listed company for 2 years. He's the former MD and CEO of PTC India Financial Services. But more importantly and more surprisingly is that the company has also gone ahead and fined Rajiv Kumar Mishra, who's currently serving as the CMD of PTC India, if you look at the website. So now also what they've done is they've barred Rajiv Kumar Mishra from taking director's post in a listed company for 6 months, which basically means that he will now have to step down as a CMD of PTC India. So, there will be some uncertainty as far as the positioning of the board is concerned, and expecting both of these stocks to, open in the red today. Now, coming to Dr. Reddy, Dr. Reddy has gone ahead and signed a licensing agreement with Ingenious Pharma. So now they've gone ahead and in-licensed exclusive rights to commercialize cyclophosphamide injection, mainly used to treat a form of breast cancer. The company will enjoy 50% profit share, and the total sales for FY24 for this particular product was close to $51.8 million. This is as per the IQVIA data. The product will be supplied by Ingenious and to DRL, and the US market will also be supplied by DRL itself.
All right, Vivek, thank you very much for that. Well, more stocks with news flow. Vamakshi is here with details on this one. Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with Gensol Engineering. The stock is expected to open higher today, and that is because it has emerged as a successful bidder for a 250 megawatt battery energy storage system of Gujarat Urja Vikas Nigam Limited. There is also a green shoe option that could be possible of a similar size, and in fact, in case if this green shoe option is exercised, the project could potentially generate revenue of around 2,680 crores over the 12-year tenure. Apart from that, Bundada Engineering is another counter that is in focus, a counter that we don't talk about very often, but a huge order coming its way from NLC India. The order is worth almost 940 odd crores. They will be setting up a 600 megawatt grid connected solar power project in Gujarat. Apart from that, lastly, let's also focus in on Arvind. After the Labour Court actually declared a strike at its Santej plant as illegal on June 6th, the strike at its plant has been called off by the workers. The operations of the plant, which were partially impacted due to the strike, are now returning back to normalcy. So this is a bit positive for Arvind, but the street will be taking note of the financial implications because the company estimates a potential revenue loss of around 180 to 200 crores, which is nearly 10% of its Q4 revenues, and a reduction in EBITDA of around 60 to 65 crores, which accounts for nearly 27% of its EBITDA in the fourth quarter. So overall, because of the financial implications, going with the red for Arvind.
Okay, all right, Vamakshi, thanks a lot for that. Well, we'll be keeping an eye out on these insurance companies as well. Yash joins us to run us through a quick analysis on the stocks and how they react. Morning, Yash.
Morning, Nigel. So, of course, life insurance companies are going to be in focus, and that is for a negative reason, as the regulator has come out with the final regulations when it comes to surrender value. Now, these are not what insurance companies would have expected, at least as per the representations which they had made to the regulator. The final regulations which have come again take those surrender value levels to much elevated levels. Now, of course, barring the long-term negatives which might occur for life insurance companies, the immediate impact because of higher surrender value would be a significant impact on the VNB margins, as expenses would increase for these life insurance companies on the surrender value which has to be paid. If I just have to put a chronology in terms of how things have moved on surrender value, this was in December 2023 when the first proposal from the regulator had come out on surrender value, which spoke about 83% of the premiums received by the life insurance companies to be paid back to insurance policyholders in case of surrenders. Of course, there was fair bit of concern amongst life insurance companies. Resistance came through, after which March it was reduced to 30%. Then again another proposal came in which took it again to 80% levels, but that was still proposal level, and final regulations have not given much respite on that, maintaining surrender value levels at 78%. So big negative, especially for HDFC Life and Max Life Insurance, which have a higher exposure to non-par products which are more vulnerable to surrenders.
Okay, so it seems the final regulations are a little closer to the original, the first draft that came in, which means that it could be slightly penalizing for insurance companies. We'll see how those stocks do. Thank you very much for that, Yash. Let's quickly recap our list of top stocks to watch then. The ones that have positive news flow around them are L&T Finance, Nestle India, Sobha, Dr. Reddy's, Gensol Engineering, Bondada Engineering. The ones that have negative news flow around them, of course, are life insurance stocks, PTC India Financial Services, as well as Arvind. Okay, so that's our stock list. Let's now move on to commodities as well and figure out what's been happening over there with the Fed meet out of the way. Manisha, so those US yields are going all over the place. So is the dollar. How have the commodity markets reacted to the Fed?
Well, the knee-jerk reactions will be clearly has been a bit of a decline because the markets were anticipating at least 2 rate cuts. Now you have 1, and that perhaps also in the last quarter of this year. And while there are 4 suggested for the next year, the markets still are slightly skeptical of that. So we have seen a knee-jerk reaction in sense of a decline in commodities. The gold prices and the silver has come off as well, both of these trading at around 2 to 4 week lows for these commodities. Not just that, if you look at the metals as a sector, we're looking at some declines coming in for this one as well. This week to begin with hasn't started so well for the base metal prices. So now we have the copper prices trading at around 1 month lows as well. The declines have also come in for the energy space, where we did see the crude oil prices gain initially, and this was on the back of stronger data and demand coming in from China and Europe. But now, because of the rise in U.S. inventories, also ongoing ceasefire talks in Gaza, crude as a commodity as well is trading in the negative 0.5% down for both varieties as we speak.
All right, Manisha, thank you very much for that. So that's basically commodities in focus. Well, all of the focus here really has been on, since the morning, has been on US CPI, right? And of course, the Fed reaction function, etc. But we got inflation data here in India as well, and that is looking good. We also had the IIP numbers. IIP, of course, a little backward looking, but CPI, of course, for the last month. Lata is here with details on both. Lata, morning.
Well, I think we must brace for a Diwali in the bond market. The yield should go to about maybe 6.95, the previous low. It closed at 7. And concomitantly, you can expect a rally in the bond markets. And I'll tell you why. The CPI number came in at 4.75. The CNBC-TV18 poll was at 4.9. Most polls were at 4.9. And importantly, the Reserve Bank's average for April, May, June, the forecast that they gave was 4.9. So if this is 4.75, we already have an April of 4.9. Chances are for the quarter, we are going to undershoot the Reserve Bank's forecast. Food inflation is still high. That's 8.7, but that's largely base effect. The year ago is 2.9. So, that's why this looks big. Food prices will rise in June. As we all know, vegetable prices are already up. But there again, you're battling a base. So it will not show up so much in the headline. It will still come in lower. But the biggest number is the core inflation. At every point, people say, oh, it's gone down to 3.2. It can't go any lower. It was 5% year ago, 5.05, and 6% 15 months ago. Look at the extent to which core has fallen. And of course, this is a calculated number. There are some economists on the street who believe it is 2.97 because they calculated a little differently. This is actually deflation levels. So now what will the Reserve Bank do will be a big issue. Their overall forecast is target is 4%. And they've always said that they will look at core rather than, food and fuel, over which they have less control. And if their targeted inflation is now down 1 percentage point lower, the cries will go up and expectations will go up that the Reserve Bank will at least change its stance. Considering that the Fed has said it's only going to cut once in the current year, maybe a rate cut will be difficult, but definitely a change in stance. And in any case, the bond markets will internalize it already. Now, of course, there are two dangers we will have to remember. That the budget is not out of the way, but the noises coming out are indicating that the fiscal deficit will be adhered to. The other big thing that we will have to wait out for is the RBI's June bulletin, where they will tell us what is the neutral rate. Now, the neutral rate is the difference between inflation, that is a 4.5% forecast for the current year, and the nominal inflation rate, nominal interest rate, which is the repo rate. Repo rate is 6.5, inflation 4.5. The difference of 200 basis points is too high. Originally, the Reserve Bank had said the difference should be, neutral rate is about 80, 90 basis points. But now after COVID gone, it's expected that they will bring it up. But will they bring it to 150, 175, 200? If in the June bulletin you get 200, then there are no rate cut hopes. But chances are they won't say that. So that's the next thing to watch, the Reserve Bank's June bulletin. And then, of course, the fiscal deficit. But today, prepare for a Diwali in banks and in bonds.
All right, Diwali in the middle of summer. But
not a good combo.
Well, Lata, thanks very much. Excellent wrap out of the data that we got here as well. We'll take a quick commercial break here. Deepan Mehta of Elixir Equities will join in for some fundamental stock analysis. Stay tuned for that's coming up.
Joining in, of course, he's from Elixir Equities. So let's get some thoughts going with Deepan. Deepan, good to have you on. You know, to start off with, I really want to take up this whole business around life insurers because it's been so many months of policy uncertainty. Finally, I think we have the full and final, surrender value norms. And they seem to be slightly penalizing from, not from the policyholders' point of view, but from the product manufacturers, the company's point of view. What's your sense on life insurance?
Thank you for having me on your show. I haven't really studied the exact details of this surrender value regulation. But look, life insurance is a great business. And end of the day, the industry has been able to navigate through many such regulatory changes, tax changes as well. And there are minor subdued demand or a minor hit on the profitability. And then it's business as usual. And the most important thing is that these products are being understood better. And the entire industry is going in for products which are more profitable. From that point of view, I think very positive on the insurance companies per se. I think valuations for private sector insurers also have come down to reasonable levels. They're going at 4 or 5 times. Now they're in the range of 2 to 3 times their enterprise value. And of course, there's this behemoth LIC. And yesterday, particularly on your channel, I saw this presentation on LIC where they actually increased their market share as compared to private sector insurance companies. And that, I think, is a very bullish sign from LIC. And considering the valuation, considering that they have such a large exposure to equities, this is one company we have a very positive view on. Having said that, we and our clients are invested in LIC, so our views could be slightly biased from that point of view. But there's a company where there's scope for the valuation ratios to be re-rated higher. And of course, it's a PSU stock, which is the flavor of the season. And I think earnings also and new business growth also can compound steadily.
So I got that, and we'll talk more about this on the insurance side as we go along. Deepan, hi, morning. So immediately, what are we looking at? I mean, you got a big sort of down move in yields overnight. We got the Fed out of the way. So where will we see as an immediate reaction function? Will it be metals? Could it be, banks and financials, IT services, or not the traditional IT services, but maybe some of the, a few which react a little bit more whenever we have yields come off? What's your sense? Or you think a lot of it is already in the price because we've been moving up non-stop?
John, good morning. It's a multiple choice question and I take on IT services, So if NASDAQ and US economy do well, then I think IT services should do exceptionally well as well. And the interesting bit is that across the board, IT services companies have been getting a lot of contracts. Order books are looking good. Contract values are looking up. It is that execution was a problem last several quarters or so. So I think if there is more certainty in the US economy, and if the entire Fortune 500 companies start to look at growing their expenditure and investment in technology, then at least IT companies will see immediate benefit of it, and at least the execution will start on a lot of these multi-year, multi-billion-dollar contracts that these companies have signed. Even if the work has started, it can be scaled up. So very positive on IT services, and per se, the great operating leverage businesses as well. Even a minor uptick in their revenues, a lot of it can flow to the bottom line. The entire pressure on costs also, mind you, has come down. I think hiring costs and salary increments are more down to earth now. And a lot of IT companies are using productivity tools within the AI space to improve their cost structure. So from all points of view, I think IT services should have a good year, 24-25. And they have been laggards so far, but I think they will easily catch up over the next few quarters or so.
Okay, all right. Hi, Deepan. Good morning and good to see you in. Deepan, I need to ask you about the cement space. I put out 4 reasons earlier this week as to why the stocks were buzzing, but now it appears the 5th reason has come about. That's normally the low-hanging fruit. There's talk of consolidation, larger players want to get larger. The Adani Group, Adani Cement listed companies, so some articles are stating today that they are on the prowl. We've heard that in the past, but actually not much has happened, barring the Sanghi asset. On this inorganic growth, will you be looking at buying some of these mid or small-sized companies?
Very difficult to say now which is the next target, because not just the Adanis, I think all the large cement players are looking at acquisition. The balance sheets are extremely strong, and they know that they have to get market share at any cost, because a lot of expansion is taking place within the industry, and by acquiring a new player in the same area or a different geography can certainly expand their marketing footprint as well. So yes, I think if there's an opportunity, I tend to think that industry players will overpay for it. But look at the dynamics of the cement industry. I think from what I read, a lot of the cement prices have been stable to have come off slightly also. Overall construction activity has been low in summer because of very hot summer season. And now we're entering into monsoon, which is also a low-key activity. By then, we'll have even more capacity coming on stream. So the picture is getting very muddled as far as cement is concerned. And I know I've been quite bearish, or I would say neutral on cement, and companies like Ultratech and I would say Shree Cement, even ACC have reported exceptional numbers. But I think that considering the valuations, considering the capacity build-up, as also the fact that input costs will gradually inch up for these companies, and I don't think they have as much pricing pressure. So look at the full picture. At best, I'd like to be neutral weight, definitely not overweight, and that too in select companies and very efficient players, maybe like Ultratech or even a Shree Cement.
All right, Deepan, a quick comment on a couple of these consumption names. Yesterday, you had Dabur, that was a relative outperformer. What do you like from the FMCG pack?
Nigel, actually nothing in the FMCG pack. I know that investors have been gung-ho because they expect the center to spend more on rural, and that would increase rural consumption. But there are other ways to play it, and could be auto, could be appliances. I think better way to play agriculture, maybe even fertilizers and agrochemicals. But I'm not that positive on FMCG. I think a lot of categories over there are pretty much mature, and volume will remain pretty tepid going ahead.
Okay, all right. Stay on, Deepan. We'll have some more questions for you in just a bit, but we also have Anuj joining in. So let's go across to him and find out what he's making of the setup today. So Anuj, this is one of those rare days where the Fed doesn't cut, but the street is very happy. What do you make of things?
Yes, so good morning. And I think the Fed perhaps would have realized that the market had already built in so much in anticipation that he didn't really need to say too much. But, overall the cues are quite positive for the market, equity positive actually. I think the most important cue was overnight from the US inflation. As expected, the US inflation was soft, and that's also tying in well with the recent data points, which indicate that sooner or later you'll have rate cuts. Now, the Fed chair perhaps was not as dovish as market would have expected. I think the market was going in with dovish expectations. And over there, he said only 1 rate cut perhaps in 2024, but 4 in 2025. So the overall thesis of 5 rate cuts is still intact. It's just that it's not going to be front-loaded. So that may be a bit of a disappointment, but the bond market didn't see any disappointment. In fact, neither did Nasdaq. Overall, yes, the Dow did slip from the highs, but the US bond market or Nasdaq reaction was not at all negative to Fed's peak. And Indian inflation was also on the lower side. So net, I would say that equity is going to the expiry with some positive cues. One more thing which is in our favor is that FIs are still short. And, like we've seen in the past, when you are record short, when you start to cover, you go until, you covered the last short position as well. And yesterday you saw a net covering of 45,000 shorts thereabout. And now if you look at the overall net shorts in the system, which was at 1.3.5 lakh, we are now at only 80,000 contracts net short and 41% long now. So maybe we get to even Steven by the time we come back from the long weekend. Coming to levels now on the Nifty, the first resistance today, remember, is expiry 23,400 to 23,450, which has been the recent high, and then 23,500 to 23,600 on the option side. The support comes in at 225 to 23,300, and then 23,125 to 23,175 based on hourly charts. On the Bank Nifty, which has been making a heavy meal of 50,000 for last 2 or 3 days, that really is your resistance. 50,000 there, about 5150 to 5250, and then 50,400 to 50,500. The support comes in at 49,600 to 49,700, and then 49,350 to 49,500. Now, for the quote of the day, if there's one speech which you must listen if you have 35 minutes and make your children listen to, it's the speech from Roger Federer. And there's just 4 or 5 very interesting things. Effortless is a myth. Belief in yourself has to be earned. Grit is greater than gift. A lot of people say Roger Federer was just a gifted player. And I think he says that, look, I had to work my way out. Discipline is a talent. Trust and loving the process is a talent. And the most important one, you can do your best and still lose in life. That's life. Roger Federer.
There was that one line, Anuj, you said, I saw that. I mean, only a piece of it. I've not heard this, but I saw it on Twitter. He said, there's no such thing as perfection.
Yeah.
He says, I've played some number of sets, he said, but I've only won 50% of them.
He said that, he won 80% of the matches.
But only 50%?
But only 54% of the points. Which also tells you that, it doesn't matter, you win all the points. It matters you win the big points. It's applicable in the market also.
Yeah.
Rakesh Jhunjhunwala used to say that, a good trader would only have 52 to 54% kind of success rate. But it's the days that matter in which you trade big and win big. That matters. Actually.
Oh, absolutely. Anuj, thanks very much. I think nice analogy here for the market as well. I remember Jim Rogers used to say that, and again, I mean, it's slightly maybe the side track, but I think makes sense. He said, I only go for the really easy, obvious ones. I don't try to do complicated stuff. I mean, it's got to be there, waiting to be picked up. I mean, he was talking about trades, and those are the ones I go for. I don't chase everything. Because that is usually sort of the road to ruin. Well, that's markets and how things are looking. But let's, I think, focus on the industrial space. UBS is expecting most of the policy initiatives for the sector to continue in NDA 3.0. We have Amit Mahavar, Executive Director, Industrial Analyst at UBS Investment Research, joining in now with some perspective. Amit, good morning. Good to have you with us here. Thank you for your time. I mean, markets have shown so much love to the industrial space. So over the last few days, we've had lots of questions. I mean, it's just kind of questions from investors, etc., with regards to policy. Will the focus shift to the consumer side a little bit more? But it's no one's case really that the focus will move away from industrials, maybe a little bit more for other sectors as well. So how are we positioned? You must have spoken with lots of investors who track the space as well. What's the feedback?
Hi, morning, Prashant. Thanks for having me on the show. Yeah, I think most of the policy initiatives on the industrial side, whether it's right on the PLI, a bit of it, or on the defense manufacturing, policy initiatives, which we've seen how it has impacted favorably in the last decade. We expect most of them to continue, and broadly, in our discussion with investors, that has been the view. But yeah, that's basically coming in select pockets. Not all segments might do well. So broadly speaking, whatever the government had started in last 2 terms. In the 3rd term, we believe bulk of that is going to continue, and you will see that reflection in the recurring order run rate in especially product companies, and even on the profitability, some of that is reflecting. Sure.
Amit, hi, morning. Good to have you on. So can you expand on that? Because given what you just said, that perhaps the ordering momentum and the policy momentum will continue, we come back to the drawing board and ask you the same question that we would have asked you before the 4th of June, right? Which is, valuations and how much is really still left on the table? Because you've got, these stocks like Siemens and ABB now trading between 70, 80 times. So can earnings keep up with these kind of elevated, price to earnings multiples?
Yeah, hi, Surbhi. So if you see, let me not go into specific stocks. I'm not allowed to talk on individual names, but I can definitely talk on the segments, right? If you see in last 8 to 10 years, right, you've seen in mobility, we've seen upgrades in rail infrastructure, right? Then you have companies which are technology leaders who are catering to that. In data consumption, you have data centers where India is one of the hottest market in the Asia Pacific region, right? So you have again very specific companies who have the portfolio of products, software, power distribution units, cooling technologies, supplying to that, or genset standby, right? Likewise, in the entire electrification portfolio, you have medium voltage and high voltage product companies which are been benefiting from government initiatives, right? And then last but not the least, you have defense manufacturing and EMS. So broadly, if you see, we are more constructive and optimistic on these technology equipment players who are not only catering to the domestic demand, but also have a decent and expanding export business. So the challenge around valuations has always been there for last so many years in industrial, but it has gone up multifold in last particularly 12 months. But I think if you see the growth, at least on our coverage, we expect 18 to 19%, new order and earnings compounding in the next 3 to 4 years, which should keep the investors' interest high. To an extent, a lot of these companies are working on expansion of their addressable market, which also justifies the premium valuations. Most of them are commanding right now. So.
Hi, Amit. Good morning and welcome to the show. This is Nigel on this side. Hope to see you on the show more often, Amit. Well, I wanted your comment on private capex. Are there still only green shoots, or is it coming back in the big way? Your comment on private capex. And what about margins? For Q4, most companies delivered good margins. But with the input cost spike, are they hitting a top?
Hi, Nigel. So first on private capex, we don't have a view that we are going to see a very strong greenfield capacity expansions like the one we saw between 2004-5 to 8-9 period. What we are saying is that in terms of the industrial subsets, the segments have increased multifold. The conventional segments like cement, steel, oil and gas, power, etc., used to be the bulk of demand for incumbent leaders. If you see today, there are like a dozen and two segments which are making the revenue streams much more diversified. The growth and earnings acceleration is far less cyclical than it used to be. Right, as I said, segments like railway, data center, the electrification portfolio is making the growth more recurring and sustainable. And in the private side, you have a lot of efficiency capex, right? You have companies expanding the portfolio of the automation that they have. The motors are more efficient, right? Deployment of drives. Then you have the entire factory setup where a lot of not only the large companies but medium and SME segment players are also upgrading the factory infrastructure. You have a whole host of new manufacturing with EMS ecosystem and defense ecosystem in India, which was not there 5, 10, 15 years ago, right? So I think generally speaking, we are of the view that the private spending is more towards upgrading the factory setup and also now catering to the export market, which might have a different requirement from a factory setup point of view. So that's our view, Nigel. Yeah.
Got it. So railways, data centers, medium and high voltage power equipment, defense manufacturing and EMS. These are the areas that you like, right?
Yes.
Yeah. Amit, on the data centers, what is published we're not asking you to talk about something which is not published on. Is there a play with which you have coverage on?
Again, Prashant, I'm sorry, I will disappoint you here. I can't give names, but you have companies which are large suppliers. The market share, you have market share which are very high for some of these, technology companies on the data center value chain.
Amit, we'll leave it there. Thank you very much for your time. Good speaking with you. Appreciate it. We'll take a quick break here. We are back. Mitesh and Sudarshan on the other side. Stay with us.
Well, let's get in our technical experts then. Mitesh as well as Sudarshan join in this morning. Good morning, gentlemen. We are bracing ourselves for a bright start. So, Mitesh, you go first. How would you trade the index?
Morning, Nigel. I think last 4 days, we've been kind of getting to levels of 23,400, 380 zones, not getting an hourly close above that. So I think that's the level which I'm watching very closely. It's a rising trend line. So the level keeps going up about 10 points or so every day. So I think 23,390, 400 is the zone which I'm watching. We will start around that zone. I think it's a 70, 80 point kind of a gap up. So once the Nifty spot gets an hourly close about 23,400, I would be more comfortable taking longs. We booked some longs on the index, but on the stock side, it's just a clear-cut situation when we are trading with a positive bias in all long positions.
Okay, got it. Sudarshan, what about you? What would your trade be? We're likely to start off with a gap up, I think, of 95 points if I got the implied opening right. What's your take on the index?
Yeah, good morning. See, my take is the same as yesterday. I have a sense that the market is topping out in the short term. The word is short term. Now, that process takes some time. So any gap up should be left alone. Even yesterday, I had suggested look for a 100, 150 point dip and then buy. And that we got that yesterday. The same view applies for today. Wait patiently for a dip. If you get a dip, a 100 point dip from the open, go long. You'll get some money out of it. But don't chase this gap up. And also, well, I'll repeat, it is giving, the markets are giving a sense that at least for the short term, they are likely to make a high and pause.
Okay, all right, Sudarshan, stay on. We'll have some more questions in just a bit. Quick break right now. We'll come back. We'll also have the pre-open rates and get to some stock-specific ideas from both Sudarshan as well as Mitesh. For the trading picks now, let's go back to Sudarshan as well as Mitesh. Mitesh, hi. So what stocks are you looking at today?
Good morning, Subi. I have all long calls today. Buy on IEX. I think good price and volume action there. The medium-term charts are turning positive, so we'll take a long with the stop below 170 for the first target of 182. Federal Bank had a strong candlestick pattern as well, so buy here with the stop at 170 for targets of 180. HUL after a good up move is giving a pullback, is now close to support level, so good entry point. 2505 should be the stop loss for long positions and 2580, 85 should be the target area. And Balrampur Chini, last 3 days I've had buy on Balrampur Chini. The stock chart still looks very good to me. There should be more on the upside, so revise the stop loss to 410, look for a target of 440.
Okay, all right. Sudarshan, what about you? What are your picks for the day?
Well, ABB is a buy with a stop under 76.20. Bajaj Finance is bottoming out. We have to keep on probing and seeing whether this buy works or not. So buy with a stop under 1500. Polycab is a buy with a stop under 65.75. And Siemens is a buying opportunity with a stop under 6512.
All right. Gentlemen, thank you very much, both of you, for joining in with that. We will, of course, have the F&O trades now. Chandan Taparia is with us, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. How are things looking? New highs? Looks like it's going to be new highs. But what would you trade specifically?
Good morning, Prasad, Nigel. Thanks for having me. So market is holding the gains about 23,000 from last couple of days. In the last week, we have seen a decent recovery from the lower levels, and now a small follow-up can lead the index towards 23,700 to 24,000. So we believe that till Nifty holds about 23,100, continue to hold the long position, and index has potential to rally towards 23,700 to 24,000. If I look at the data internal, your India, which is continuously falling down, is now below 15. So lower volatility with rising put-call ratio supporting the overall sentiment of the market. Now, if I talk about the Bank Nifty index, that is also holding well. Now a small follow-up and pole unwinding of 50,000 can take it higher levels. So 49,500 is the major support. And with this support, banking index can head to us 50,500 to 51,000. Now looking at the stock wise, first is buy on IEX. After a long time, we have seen a consolidation breakout on the daily and the weekly chart. It is trading at multiple months high. It managed to close above key hurdle, and follow-up is clearly visible with bullish price pattern. On derivatives front, we have seen open interest decline with surge in price, which clearly indicates short covering. So momentum could continue. One can buy with support of 169, and IEX can head towards 181 to 182 levels. Second trading area, there is buy on Crompton. Strong price pattern. We have seen open interest surge by around 45% in last couple of days with positive price action. In fact, we have seen some put writing. Put call ratio of the counter is increasing. Technically, it has given a breakout from its pole and flag pattern. So one can buy with support of 412 and it has potential to rally to us 444 level. Last trading area, there is buy on Concor. We have positive on the selective railway name and Concor has recovered well from the lower levels. We have seen momentum, major trend is positive. So one can buy with support of 1180 and here we have a target towards 1200 zone in the Concor.
Okay, all right, got that. Chandan, thank you very much for your trades today. Let's now shift the focus to the financial space. We have Rahul Jain, co-head of Asia Financials and head of India Research at Global Investment Research at Goldman Sachs with us now to talk about his view on the overall sector. Rahul, great to have you with us on the show. You know, we've gone through this last week and a half of a lot of up and down in terms of what's going to happen with policy. Will it be more consumer focused now? And I think the market settled down to the view that there'll be policy continuity and therefore the capex focus should continue. But the funny part is while PSU stocks keep shooting through the roof, while capital goods stocks are trading at 80, 90 times, the money is not flowing into banks, which is supposed to be funding. I'm assuming if you're looking at fantastic economic and capex growth, then it's the banks that are supposed to be funding it. And yet we're not seeing that kind of investor love towards the banking and financial space. Your thoughts on this?
Sure. Good morning, Surbi, and good to be on your show. Look, I mean, before I straight away drill into the question that you asked, let me just paint the overarching view that you've got in the sector. So a couple of months back, we actually downgraded the earnings in the sector basis three key reasons. Number one was the cost of funds likely to remain elevated, and we have seen deposit rates going up by select banks over the last couple of months. Number two, the consumer leverage, which has been increasing, that's been raising the fears on potential NPLs coming through in the unsecured credit space. And of course, the third aspect was around the operating expenses, which so far along banks have managed it well. But given the fact that deposit mobilization is the key, banks will need to keep upping their investments in their resources and the branch infrastructure. So clearly, there would be some earnings, facing the headwinds, at least in the near term. And in that aspect, clearly the investors are taking the view that where do they get good visibility in the near term. To answer your question, the reason why the private banks may have underperformed in the last few months or maybe last few quarters is because of both the technical reasons as well as the fundamental reasons. Technical reasons are well known. The flavor of the season has been the PSUs across the board. We have seen the PSU banks show good performance over the last many years. The other technical factors was the foreign flows into the country has been rather subdued compared to the domestic flows, and the flavor of the money in domestics has been more on the small and mid caps of the PSUs. On the fundamental side, like I just painted the picture, the visibility on the earnings growth has been a bit more hazy, at least in the near term, and that could be the reason why investors have chosen to look at other sectors compared to the financials.
Just to clarify, despite the headwinds that you mentioned, and that's the whole fight for deposits, increasing consumer leverage, which may lead to some more NPLs and rising operating expenses, despite those headwinds that you described, Rahul, you still have buys on a lot of the large blue chip private names, right? Axis Bank, HDFC Bank. You also like IndusInd. I believe you like Kotak as well. So just explain that. Are these sort of more insulated from the headwinds you just mentioned?
So without getting into the stock specifics, I would say that some of the private banks clearly would be better positioned because their incremental market share gains in deposits have been better, or their management of the operating profitability has been better, either through better margins or better fee income, which has been helping them absorb the operating cost. Some of these banks also have been at the forefront of investing in, opening new branches, putting more resources at the ground level, which is helping them gain more deposits. So when one looks at over the next 12 to 18 months, we believe that the market share and deposit will play an important role because that also will allow you to get more customers and therefore get more operating leverage out of that. So really speaking, it's a call one is taking on the operating profit growth where one would have a more visibility, and compared to that where the valuations would be. We've seen the valuations also get derated for select private banks quite steeply, and when you compare to the fundamentals, you do see a a good opportunity for investors to buy into these names.
All right. Hi, Rao.
Guys, sorry, just a anecdote. Only yesterday I was talking to somebody, an investor, and he said, well, people ask me what to buy. He says, I tell them SBI. SBI will double in 2 years, whatever, Is where people don't want it. Something more masala, exciting, chota, small cap, mid cap, SBI as an idea. I mean, but that's true, right? When you think about what is an idea, sometimes the best idea could be
the most boring one.
Yeah, the most boring one. But I found it interesting that, well, people just don't believe. They just take it because it's, why do we need you to give us SBI as an idea? Even if they don't own it, I guess, right?
All right, let's get Rahul's view. Rahul, hi, good morning. Welcome to the show. Nigel on this side. Talk about SBI. What's your view on some of these other PSU names? That's clearly been the space that has done very, very well. All those concerns have been, put aside, and the PSU banking names have done very well. At current prices, bulk of the good news is in the price?
Hi, Nigel. So again, going back to the overarching view that I painted, right? If you look at the PSUs, they've done a good job in the last 3 to 4 years. We've seen the ROAs improve like almost 4x from 0.2, 0.3% to now about closer to 1% or thereabouts. And the market has rightfully rewarded those. The valuations have improved. But now what we are observing is the valuation gap between the private and the PSUs have narrowed a lot. And when, and when you're talking about the normalized macro environment over the next couple of years, it again comes back to which entity, which segment will be able to better protect the profitability both at the margins front as well as at the operating profitability front, while gaining the market share in deposits or credit. And there we are seeing that private banks have done a good job. At least in the last year, there was a lot of focus on whether PSUs will be able to retain the market share in deposits or they'll gain market share because they now all come back into the game with good capital ratios, with healthy balance sheets. But what we are seeing is the private banks still continue to gain market share out there. So in our opinion, we feel that there is more value in owning the private banks at this stage than the PSUs. And that's been our call, for the last couple of months.
Rahul, I wish we had more time, Prashant here, but we'll pick up on some of these points that you made in a later conversation. Thank you very much for joining us. Great to speak with you here on CNBC-TV18. So that's Rahul Jain. He's co-head of Asia Financials and head of India Research, Global Investment Research at Goldman Sachs. Let's now get you the 9-10 calls. Mitesh is here. Mitesh, what do you have?
I'll choose a long on IEX with a stop at 170 for targets of 182.
IEX as a long. Targets of 182. All right, fair enough. Now, Mitesh, thanks for that. Surrender value, back to it, right? The final norms are through. From the first time that we reported the draft in December, then the dilution early this year, then, of course, the last draft which was put out, and now this, the final norms. How do they look? Yash is here with the spotlight on it. Yash, morning.
Morning, Prashant. So as you rightly pointed out, multiple rounds of discussion over the last 1.5 to 2 years, multiple ups and downs. And finally, the regulations on surrender value are out. And let me tell you one thing, life insurance companies are definitely not going to like it. Especially the impact is going to be maximum on 2 life insurance companies, that is HDFC Life Insurance and Max Financial Services. That is because they have the highest exposure when it comes to non-par segment, non-participating segment, which is most vulnerable to surrenders in this particular case. Now, what the regulator, through its final regulations, has said is that the surrender value will be kept at elevated levels. Remember, just last month, the regulator had put out a draft proposal only to the life insurance companies, suggesting the mechanism in which it thinks special surrender value should be increased, after which there were representations made by life insurance companies seeking various forms of relaxations. But the regulator, let me tell you, on most of those points haven't budged, except for a small relaxation which has been given, which is that the 10-year GSEC yield, which is used to calculate special surrender value, that on that a special cushion of about 50 basis points has been given. Now, I won't go into the formula, but through the formula which has been prescribed by the regulator, if 10,000 rupees premium is paid in the first year for any life insurance policy, it's surrendered in the second year, then life insurance companies will have to pay 7,823 rupees as surrender value, which is what? 78% of the premium which they receive. Remember, the first draft came out in December 2023, which created concerns amongst all life insurance companies because it proposed 83% surrender value. which was then reduced to 30%. But then regulators spoke about increasing the special surrender value and taking it back to 82% levels, the same concerning levels. And now, with that small relaxation also, it still stands at 78%. So big negative for life insurance companies.
All right, Yash, thank you very much. This table on your screen is the most important. It basically, in a snapshot, tells you where we stand. There was hope in March. Stocks had rallied, remember, when the draft tweaks to draft had come out. But now we are basically back to the May level. So about 78%. Great news for consumers, you and me. But as insurance companies and stockholders, I mean, not so great news. So that's the insurance bit in terms of news flow. This entire surrender value saga coming to a bit of an end now. Let's just take a quick look at what the pre-open is going to is looking like, and of course what the opening itself will be coming up on our screens in just a bit. The first rates on the Nifty, the Bank Nifty. By the way, the mid and small cap indices have been firing. Yesterday, both indices were up 1 and 1.25%, and I think you've got momentum there. The Fed reaction function immediately, will it show up in specific sectors? Like, for example, IT yields are down, although IT services companies here are very different from the IT that we speak about in the US. Metals, perhaps, dollar is down about 0.5%. Naturally, that's a sector which will be in focus. Financials is the other space as well, as yields here are also expected to cool off. Lata was talking about the CPI numbers here. Few seconds, and I think we are going to hit the opening, sort of market opening on your screen now. So you've got the Nifty, which is starting at a new high, 23,428. It's up 104 points. I think we got to 23,440-ish kind of levels yesterday at the high point. So I'm not sure if we'd really hit that, but we're there at new all-time highs for practical purposes. The Nifty Bank, I think, is also starting higher. The indices, that is. Nifty Bank is up 170. That's about 1/3%. 50,055 is where the Nifty Bank is at. The mid-cap index is up 0.8. And I'm thinking about the small cap index, which is also starting in the green. So those are indices, but as always, it's about stocks. So let's get this going.
Oh, absolutely. I mean, once again, the mid-cap index is off to the races. It's, the gain there is almost 1% versus the Nifty's tally of 0.5% right now. By the way, I think the L&T Finance block here, that's happened. That stock's up about 3% as we speak. Sobha, which is looking at more fundraising, rights issue, is up about 4% as well. Look at some more names in the broader screen. Transformers and rectifiers, 5% higher.
Look at life insurance as well, Surabhi.
Oh, yeah, absolutely. Good you pointed that out. Let me pull up some of those stocks. ICICI Pru is down about 1%. Max is down about 1.5%. SBI Life is actually, positive, is up about 1%. Even HDFC Life, for that matter, is up 1%. Seems the market's kind of digested this because there's been so much back and forth over the last, I think, 6 months. These regulations have gone all over the place. And again, the narrative, at least some of what I was reading was that now, how much surrender value do you have to give in 1 year? The counter argument was that the persistency ratio is actually pretty high for policies. It's well over 80%. So, I mean, how much is the real impact? May not be that much, at least in terms of the 1 year surrender rates that have to be given in. So actually, life insurers are managing to take this up pretty well. Nestle was a stock in news because of no higher royalty to the parent, 2.5% up on that stock as well. So these are some of the early movers and shakers as we see on the volumes charts. It's not all PSUs, which is the norm. It's some other names as well. Some of the sugar stocks, by the way, Renuka, Bajaj Hindustan, they're looking quite sweet and attractive as we start things off. So that's how it's going. Overall, 1% higher on the mid-cap index.
Well, that's right. If you look at a numerical number, we went ahead and we got that. The high of the day is 23481. So we did that 23456. That's the number that our colleagues at Aavas as well have been tracking, Anuj and team. They've been talking about that 23456. Well, that came about earlier today, and now we have slipped a little bit from the top. Stocks that are moving around. Heritage Food is under some pressure. That's coming for some profit taking after the big run that we saw in the past week. And, it's down close to around 3%, but I think it was down 5%. So it's cut its losses a little bit. Heritage Foods comes up for you on the screen. Dabur, yesterday it was doing a relative outperformance. Today, in fact, that stock is under some pressure. It's down close to around 3.5% or thereabouts. So we should get that one as well up for you on the screen. Heritage Foods, Dabur, both of them are coming up. We have L&T Finance. Well, that could be the stock of the day, as we mentioned earlier today. So we just mentioned that as well. Block getting out of the way. Valuation's very attractive. So that stock is up close to around 3%. GMR Power, that's another stock that's opened up with a gain of close to around 5%. So big move is what we're seeing on that one. And Trent, yesterday they had their AGM, so that stock had opened up in the green. Valuations are not cheap. It's flattened out a little bit. They aim to maintain the pace of store additions. They're talking about 30 West Side and 200 Zudio stores. They're also highlighting that Star could be the third engine of growth. So that one, in fact, has flattened out. Yesterday it was up close to around 3% or thereabouts. So good start. Breadth of the market is something that's very, very good. We had 8 stocks that are advancing for just one stock that's declining. But Surbhi wants to comment, please.
Guys, I just want to point out that this is not limited to Dabur, Nigel. All of FMCG is under a lot of pressure.
HUL, Marico.
HUL, yeah, exactly. Marico, Colgate, Britannia, Godrej Consumer. It's just pretty much across the board.
Yeah, I mean, so that's one sector. I think even yesterday, I think FMCG was one of the few sectors which was down. So there is a little bit more profit booking happening there. The last week, Friday to Friday, was a big week for FMCG stocks. The index itself ended about 7% higher. That's last week. So yeah, I mean, there is that positioning there. Heritage Foods is down 3.5%, about 4% now. I mean, and we maybe also, look at KCP, which is the other one of these movers, which is, of course, this entire election excitement with what's happening there. It's had a big move, KCP. Elecon is down 2.5%. Sun TV was a big mover yesterday. It was up about 4%. It's down about 1.7, 1.8 right now. Godrej Consumer Products is down about 1.5%. And you've got PVR Inox, which is down 1.5%. I have to point out that it's still early, but it's a little slow as opposed to what we've had right out of the gates. Big volumes and a very vibrant screen. Today, it's a bit slow. It's still the first few minutes, and maybe it'll change, but not. It's not a whole long list of big volume-led movers that we have. Soba, of course, we highlighted. Lodha is up about 5% as well, 5.25% as well. These sugar stocks are up. Renuka, Bajaj Hindustan. I mean, one can spot these. JM Financial is up about 4%. There is you got to go down the list. But DBL, Dilip Bilkon is up about 4%. A name like Kriti Industries, Nimesh had that on his D Street chatter list yesterday. 5.5% after yesterday's 20% move. Repco is up about 3.5%. But then volumes start to fade away as we go down. Reliance Power, good move yesterday. It's up about 5% this morning as well. So that's the market open. 120 odd points higher. 23,440 is where we find ourselves at. Our market master is with us. Devina Mehra is founder, chairperson, and managing director at First Global. Devina, good morning. Great to have you with us here on the program. Thanks very much for your time. Up and up, breathless, runaway rally. I mean, I think we can run out of adjectives, or maybe we won't, describing this the move that we've seen. And what has been remarkable, Devina, is over the years, these sharp pullbacks take lesser and lesser time to recover. You go back the last many years, and this one, the last week was, I think there was a headline I read, which is the second fastest pullback after a sharp fall. Buy the dips and how. Just your thoughts on the context we are in right now and the way forward.
Good morning to you and to the viewers as well. If you go back to my pre-election interviews, I had said precisely this, that we are spending too much time thinking about the election results. And the parallel I had given was 2004, where not just stocks, the whole market was circuit down and the trading had to be halted. And then you had the pullback. So I had said that, regardless of the election results, the markets and economy have a logic of their own, and that trajectory I do not see being changed on a 1-2 year basis. However, there might be interim volatility. So prior to the elections, in our PMS portfolios, we were fully hedged. We've cut about half the hedges, but we are still about half hedged, because in the short term, you might still see some volatility, but that was not my post-election analysis, that coalitions are not bad, etc. That was my pre-election analysis too, that regardless of the surprise or otherwise the election results, that doesn't change the trajectory of the market that much, and which is why we were always in cash. Even we had no cash. I mean, we never made a cash call. We were hedged.
Devina, hi, great to have you with us. And I want to start by complimenting you really on the debate that you raised on social media, because very few people in the market are able to do that. And I thought we really called a spade by saying, what is the definition of reform? Anything that benefits the market, anything that benefits industry is obviously reform. But if there is some populism, if there is some giveaway in terms of, any of the more rural-focused schemes, is that really such a bad thing? I thought that was a very, very, thought-provoking post. So let's actually get your deeper views over there. I mean, I think the market's now, settled with a very cozy expectation that nothing will change, policy continuity will go on. But is that such a simplistic view we should be taking as we get ready for the budget? And if there are some giveaways, would you see it as immediately negative for the market?
Surabhi, I mean, in your question itself, by using the word populism, you made it seem as if
this is a bias.
Negative.
Absolutely.
So,
it's a bias that we're all guilty of. Yeah.
Just as in company management, the way you manage a company, you have to balance the short term and the long term. So also it's exactly the same thing for a government, that you have to manage the short term, but you also have to look for the long term. And in the long term, you have to, two areas which you really have to focus on is health and education, which actually ties into employment, which ties into consumption, because private consumption growth has been very poor, and we really need to up that. And unless you have better employment, you will not see consumption going up. And to have even employable people, you need the health and education spending. So that's not, money down the drain. And one of the parallels I had given was the midday food scheme. And I still remember at the time, I think I must have been in school or something, but when MGR was pushing this midday scheme in schools, the general consensus was that we should not do this. This is a huge fiscal drain. But look at how it transformed Tamil Nadu. Tamil Nadu, which used to be among the poorest states a few decades ago, is now in terms of poverty, or rather absence of poverty, is the number one large state. Above it are only one or two very, very small states like Goa. So that is the transformational effect of interventions at that stage. Giving cycles to girls, again, looks like a giveaway, but that changes the mobility, that changes the number of girls who are able to study beyond a certain standard, because the high school or the college may be far away. So you have to balance that. And also, see, we are only looking at the spending side. Even on the spending side, for example, if you have to give even a giveaways, so to speak, to business, which is considered reform, is corporate tax cut the best way to do it? Because, if you look at the high tax paying companies, who are they? PSUs, banks and financials, and MNCs primarily in consumer goods. Now, giving them a tax break is not going to give a boost to any investment. So if you want, for example, investments by businesses, it has to come elsewhere. So that's one part. The other part is, how do you fund whichever segment you are trying to spend for, whether it's businesses, whether it is the poor. And that, if you look at, again, if you look at the fiscal way, if you want me to go into it, I can go into it, but because that's also very equally important, that how do you fund it? Because in the past, we have spent on social concerns without increasing taxes and having the debt go.
Okay, all right. Hi, Devina. Good morning and good to see you. Let's talk about markets and how you approach it from here on. You had added, I think, some cement, some metal-related stocks as well. And you'd also mentioned, I think, that tech at some point of time will bottom out during this year and could give an entry opportunity. How are you positioned right now? The top theme that you like and something that you think has already played out? I think industrials was something that you believe most of it had played out.
Yeah, industrials, but we still remain overweight. We are watching to see whether it will top out sometime. But for now, we are still overweight. We are overweight auto components, pharma for the last year and a half. Yes, we had added in metals, but that's, even last time I had said that in metals, or for that matter, any commodity, you don't know how long the rally will last, because there are many more users of commodities than producers of commodities. So a commodity bull run hurts a lot more people than it benefits. So we are just watching. Metals are kind of at a crucial point. We are watching which way the thing turns. In terms of IT, yes, we think sometime this year it will bottom out, but we are not yet overweight on IT. So, one of the sectors you asked, that would be the broad view.
We've again, the other point which we're not talking about that much now, but which sort of occupied a lot of mind space was mid caps versus large caps. How has your thinking evolved there, Devina?
So, I mean, if you go by SEBI definition for mutual funds of large cap, mid caps, now the way they define mid caps are also pretty large caps, because it is not in terms of market cap, it is top 100, then 250 and so on and so forth. I mean, not so much the mid caps, which as I said are pretty large in themselves. The part where we are very, very careful is anything below a 5,000 crore market cap. We don't even look at micro caps below 1,000 crore market cap, but even 1 to 5,000 right now, we would still be very underweight compared to where we normally are in that segment, because we think the risks are high and we always manage for risk first. So that's been our philosophy. And even without taking that exposure, I mean, the portfolios are doing pretty well with lower volatility. So I'm happy with that. I'm not trying to be this high risk taker, trying to get all the sixes.
Okay, they've been asking you about one hot sector on which I think the market's also trying to make up its mind, and that is life insurance. The rate at which policy changes, whether it's tax policy or some other policy, can get really confounding. But I don't know if you managed to see this whole sort of situation around surrender value, because I think finally we have the regulations. They are not as easy as what one was hoping, I think, back in December. But in case you've seen the latest on this and if you'd like to share any thoughts.
No, I have not really gone into the details of it, simply because we currently don't hold any our portfolios. But we are certainly looking at it. So only if I have a clear mind, I like to comment on it.
Financials, how else are you approaching it? What are you still liking in financials? Large banks has been a non-starter of a space for a long time now. What about NBFCs? What else do you like here?
So banks is not something that we particularly like. As I've said plenty of times, that's a sector I'm always wary of. And if you look at the macros in terms of household debt, not so much also the percentage of debt to GDP, but if you look at the servicing ratio for Indian households, the debts that basically your debt service as a percentage of income, that's very high. That's, in fact, I was looking at some number which showed that it is as high as what it was in US just before the 2008 crisis. So that doesn't give a lot of comfort to the lenders. But basically, I mean, I always think that lenders growing faster than expected is not always a good thing, because how difficult is it to give away money? It is getting the money back that's a problem. Having said that, because banks went through a very long period of underperformance, they may not underperform so much anymore. We have added some banks in our last rebalance, but we are still significantly underweight, and we are still significantly skewed towards the PSU banks.
Okay. All right, Devina, we will leave it on that note. Thank you very much for joining in. I really appreciate you being with us on the show today. Okay, that's Devina Mehra's view on the market, which is actually a little quieter than most mornings. So just about 80 points higher on the Nifty right now, and even the mid-cap space, just about 0.5%. So it's not off to the races today.
Well, that's right. Well, good time to get in our next corporate then. Cummins is the stock that is in focus. Macquarie, well, they are bullish on the stock with an outperform rating. Keep in mind the stock has been buzzing this year. It surged more than 90% odd. So how is business momentum and how the outlook from here on? Well, we're joined by Mr. Ajay Patil, the CFO of Cummins India. Hi, Mr. Patil. Good morning, and always good to have you on the show. Let's start off with focus on CPCB4. That's finally seeing the light of day. So how is demand for CPCB4, given that, for the buyer, the prices go up by close to 40-50%, a rough estimate out there. How is demand on ground, and how's the competitive intensity?
Hi, good morning to all of you and the viewers. Always a pleasure to speak with you. I think, yes, the transition is now July 1st of 2024. So we got an additional 1 year, which was granted last year. What we have seen throughout the last fiscal year is a good interest and demand for CPCB4, while the customer still had a choice of buying the CPCB2 products, which is a function of how we got our products ready on time last year. So we had our products ready as per the original deadline. And we have seen that interest and demand come throughout the year. Now that we eventually transition to the CPCB4 Plus from July 1st, we do expect that the demand momentum to sustain. While always there could be a period of transition, maybe a quarter or so, just because there will be inventory liquidation which would happen this quarter, which might have some impact in the following quarter. But generally, directionally, we don't see any potential impact from a demand perspective. The second point you touched upon was on pricing. Clearly, we are looking at a step up in terms of the product and the technology. And therefore, there is a price impact that we have seen. Our experience of last year is that the price point that we have offered was something which resonated well with the customers from the value that we offer. However, the price discovery for the CPCB4 Plus, now that most players would have their product ready, would be a function of the next 2 to 3 quarters, is how we are assessing the situation.
Mr. Patil, hi, morning. So you're saying that pricing will take some more time to settle. Is that what you're saying?
That is right. That is right. Because as players come, I think the discovery process will play out in the next 2 to 3 quarters.
Sure. Okay. And post the 30th of this month, you can't sell the older products, right?
That is correct.
Okay. Now, Mr. Patil, just talking about demand drivers, what we, globally, one of the big sort of drivers is data centers, right? Could you tell us where are we? I mean, how much is data centers contributing to your revenues right now? Is that going to be the big growth driver with sort of plans afoot for building data centers across the country in a very large and aggressive way? Just give us some color, sir.
Definitely. I think it has emerged as one of the fastest growing segment. And in our assessment, I think it is going to be a multi-year, if not longer, in terms of how this segment is going to play out. I think the underlying rationale for why data center growth is there is well known in terms of how the digitization and the way in which the economy is transforming across multiple sectors. Take it from supply chain, e-commerce, banking, financials, or even the B2C forays that most companies have. Keeping that in mind, what our assessment is that given the need and the on-ground installation that we have, the pace of growth for data center as an end market will continue to be in high double digits, is what we think. At an overall data center level, not necessarily from our revenue perspective. What we have seen, though, in the last couple of years, that it is one of the fastest growing end market for us. And we are well positioned related to the product that we have and the technologies that we offer on the reliability that is demanded. And therefore, I would expect for our revenue composition as well as a generic data center as an end market, it's going to be a multi-year foray.
Okay. More questions on data centers in just a bit, but I just want to go back to the CPCB norms to understand, sir, what we see in the auto sector usually, for instance, whenever there's a transition to the next norm, next stage, BS5, 6, etc., there's a lot of pre-buying. Is that evident in your segment as well? So like April, May, June, has there been additional sales before one moves to the new set of products under the new norms with much higher pricing? And typically, the average pricing, how much higher is it as of now? I mean, if a customer is to come to you on July 1st for a product in the same category, with the newer norms, how much is the price increase?
Yeah, definitely the pre-buy phenomena we experienced last year same time. Because as you recollect, the original deadline was July 1st of 2023. And which means the quarter of April to June 23, we had seen an uptick on the pre-buy. I think somewhere towards the end of June, the deadline was extended. And therefore, what we have seen throughout the year is that the demand sustained on the CPCB2, and we continue to sort of position our product and got good response and good sale for CPCB4 in the last fiscal year. Having said, what we are experiencing now is really a phasing out of inventory, I mean, from this quarter perspective, because the pre-buy phenomena has played out in April to June 2023 quarter, as well as throughout the year, is how we are seeing it.
So that's important because that means that, I mean, we're only looking at quarter to quarter and how we need to analyze the numbers as well. So that means the base quarter already has sort of higher sales because of the pre-buying that happened last year as you're describing. So that's one. And now there's been inventory liquidation. So to what extent have prices come down? Because, of course, companies are, finally getting rid of inventory. Coming back to that point on competition that Nigel was raising.
I think the pricing is more important to see what the pricing differential is going to be for CPCB 4+, because we are talking about a step change in the technology. We are talking about all electronics engines which are needed to comply to the new emissions. And therefore, in our assessment, and it is a broad range of products we are talking where the emissions are applicable. As we know, the emissions are applicable up to 910 kVA product. And the pricing, depending on which node and application, could be in a very broad range of between 15 to 40%.
All right. Mr. Patil, I wanted to ask you about the distribution segment. I think that's around 10% of your mix?
Not necessarily 10%. The total revenue level, I think it is a little more than 10. It's closer to 22 or 25%.
22%. Okay. All right. And that's growing at a faster clip, and I believe that's relatively better margins?
That is correct. I mean, our distribution business, which is parts and services, obviously has a higher return. And it has been experiencing a pretty strong growth as a function of how we have focused on this business over the last 3 to 4 years.
Okay. So what kind of growth, sir, can you guide for this distribution segment of your business, which is parts and services, which, as you say, is around 20% roughly of your business mix? Will it outgrow the business, and what is the pace of growth you're looking at?
I think if you would have looked at the last 2 to 3 years, it has generally grown in excess of 20%.
Yes.
I think what is important to know is that the way our distribution business is positioned, when we sell out the first product, that requires a substantially long period of services and maintenance. And the number two, we being in the country for past 6+ decades, our install base is very large. And what we are really focusing on as to how do we continue to drive a stronger penetration on the install base that we already have, and mining that install base and converting into some service relationship is really the emphasis that we have been giving. And we continue to hope that we maintain the growth rate.
Okay. All right. Mr. Patil, you have given us a fair idea about business. Now I'm looking for a couple of numbers, and I hope you're going to help me out with that.
Sure.
Exports has been a bit of a sticky region because geopolitical risk, you have supply side issues as well. So in which quarter do you believe exports get back to the normal contribution? I think they came down to high teens, in the last quarter or so because of the pressure that we saw. So by which quarter? Is it a story of quarter 2, quarter 3? And also margins. There were a couple of one-offs in the past quarter, and the street was very excited about that. But then you clarified on the con call. So a rough margin guidance, and when do exports go back to what we have seen in the past?
I think exports, what we have been very consistently providing the commentary over the last years is really a function of 3 or 4 factors as to why the end market demand was softer. In our assessment, what we believe is that the exports demand is kind of coming to towards the end of its bottom, and we expect it to sort of rebound. Now, really the most important question is, what is our assessment of rebounding, whether it can rebound in 1 quarter or 2 or 3 quarters? I think that's a difficult one. But if you see the composition of exports that we have between low and horsepower, the high horsepower products, I think on the high horsepower side, we are already seeing some sort of a rebound of demand. Low horsepower, we believe, might take some more time. Hard to tell exactly how much a period it will be, but we do see the exports, slowly rebounding back to traditionally where we have been always maintaining from a revenue profile of our domestic and exports. Number 2, you asked me about margins. I think, consistently over the last 2 to 3 years, our emphasis on margin has been there. And what we continue to really look at margins in really a 3 or 4 manner. One, as to how much of pricing we can extract in terms of driving our margin expansion. Number 2 is with respect to a very disciplined material cost management that we continue to do. And then, of course, the obvious element of how we continue to manage our discretionaries. I think a combination of that has really helped us maintain a very strong momentum on margin expansion. And our endeavor is to continue to sort of hold and improve on the level of margins that we have. Already,
so that's sorry to come in over there, but that's what we're trying to understand, because the exit margin at the end of FY24 Q4 was at, I think, record levels, 23.5%. But then you said that there are some headwinds with respect to material costs. So now I'm asking full year numbers, revenue growth as well as full year margins. What should be a reasonable expectation to have?
I think on the revenue, we are already guided that we will have a double-digit growth rate for this year. That's the guidance we are already provided for. Margin guidance we haven't yet provided for a reason that we continue to see some, uncertainty and volatility with respect to how the commodities. We would have observed that the copper and aluminum has run up, and so is some amount of disruption when it comes to global supply chain. So therefore, we are not guiding on the margin side, but I think on the revenue, we continue to maintain that we'll sustain the double-digit growth momentum.
All right, Mr. Patil, we'll leave it there, sir. Thank you very much for your time. Great to speak with you. Appreciate you joining in with that perspective. Good luck, sir. We take a quick commercial break here. We have Mr. Vikas Gupta of PG Electroplast joining in to talk about product sales, AC sales, for example, which have been blockbuster in the summer season. We are going to get to him in just a bit after a quick break. Welcome back. The market's looking good. It's up and about, and 60 points. I mean, so there is a bit of come off which has happened. We were up 120, so gains sort of cut in half. But the fact is that the market's been doing very, very well over the last couple of days. Insurance company reactions are pretty interesting. Stocks are up 2.6% in HDFC Life. Max Life is up about 2.5%, and a few others as well. So, I mean, the reaction could be off of the fact that the May draft norms which had come, that basically said that out of 100 sort of, about the surrender, what insurance companies will have to give back as surrender value to insurance companies has to be 82%, that table that we put up. And now the final norms say it is 78%. So, it is not that different. So when the last month the draft regulations came, stocks had sold off. And this could be just like a clearing event with the overhang out. Now we know what is what, because this has been now going on for the last many months now. So that's the insurance sector. We'll try and have insurance companies join us because, I mean, the hope, of course, is this is 100% going to impact VNB margins on the non-par side. But the hope is that insurers will be able to adjust for this based on adjusting commission structures, etc., that they'll be able to offset it. That's the hope. But we'll have to hear it from insurance who we're trying to get. Let's move on to our next corporate right now. PG Electroplast is the company on our radar. The summer season, of course, has been scorching heat waves, record-breaking heat waves. AC sales, as our colleague Shilpa just told us, she did an industry-wide check. She said that AC sales for this season have been absolutely blockbuster, the best ever in the last 3 or 4 years now. Let's get a perspective from PG Electroplast on this and more. Vikas Gupta is MD Operations at the company. Vikas, good morning. Great to have you with us here. Thank you very much for your time. So just, I mean, on the AC side, if you can tell us what are ACs as a percentage of your revenues? And now we have the season is kind of almost behind us. That it's been one of the best ever. Do you want to sort of give a relook at your full year numbers a little bit higher? Is there an upward drift here, or you'd stick with what you told us in late May?
Good morning. Definitely the AC sales are looking very robust, very strong. In fact, in the first half of calendar year, I think we must be experiencing a growth of upward of 50% as compared to last year. and all our clients have reported a very strong numbers for sales for the first half. In fact, the channel inventory is almost, the position is almost like a stock out kind of position. And the heat wave is still quite intense in the north part of India. So definitely the numbers are looking very good for air conditioners. Air conditioners for the current financial year, we have given a guidance of sales of almost around 1,800 to 1,900 crores out of 3,400 crores, which is almost around 55 to 60% of the sales for us. So AC is looking quite good for the current financial year, and we will not like to revise our guidance of revenue for upward revision this time. We'll be reviewing the position. Please understand, when we released our guidance, it was already in the late May. So we have already factored in the performance of the first quarter of this financial year.
And you're saying that inventory levels across industry are almost, out. There's no real inventory out there.
Yes. So there is always, still there is some pressure for the dispatches from our certain clients for the northern Indian markets. So we are fulfilling those requirements. So definitely the stock position is not very good in the channel right now.
Okay. Sir, can you talk about the expectations from here on margins and also sort of the factors at play, including your input costs, including, of course, how you're expecting pricing to be in the months ahead. So what's the outlook?
We would like to stick to the guidance of the PAT that we have given in our release of around 200 crores. That is what we would like to stick to. Right now, definitely the commodity prices are looking to move and inch up a little bit. We are just keeping a watch on that, and we might have to go for a price increase with our clients in coming quarters if this price pressure continues.
All right, I'm Mr. Gupta. Good morning and good to see you. And let's focus on the TV business. That's going to be another revenue growth driver from here on. The fear is that the TV business itself is in a little bit of overcapacity. I wanted your comment out there. I think Dixon, one of the larger players, they also delivered a degrowth in the past quarter. So that's from where the fear is coming about. I'm reading a sales note and they had mentioned this. Your comment on it? You don't think so?
So Nigel, please understand, we are coming with a very small base.
Yes.
Last year, when we look at our sales for televisions, which was almost around 350,000 TVs that we sold in last year in our parent company of PG Electronics. So as we have moved our TV business to a JV company, which is Goodworth Electronics, we are very confident that we should be able to build on those numbers. In fact, we are looking at a revenue of around 600 crores for TVs from our JV company of Goodworth Electronics. We have already onboarded 4 new clients in the current quarter, and we are the kind of order book and the kind of forecast that we have for the upcoming festive season. It is very promising, and we are confident that we should be able to achieve those kind of sales figures.
Okay, that's TV. So broadly, tell us, so in FY25, we are almost, down one quarter. What will the big focus be in terms of the revenue breakup? And going forward, are you eyeing any new segments?
So please understand, definitely the product business will be a major growth driver for our revenue growth in coming financial years, for the current financial year as well. As we have given a guidance of around 3,400 crores for sales in our PG Electronics, out of that almost 2,400 crores will be coming from the sales of the products, which is mainly comprising of air conditioners and washing machines. So that is a growth of almost around 43% in that. Definitely, we are eyeing for new industries and new product categories. We are evaluating certain opportunities, and as and when we are able to mature that, we will be sharing the details with you. So definitely, we are looking at a growth pattern to continue for next quite a few financial years.
Can you give us a hint on what new categories?
So it will be basically, we will be trying to see how we can leverage our current manufacturing capabilities, and we will be getting into those products only which align with our current manufacturing infra, where the focus will be to see how we can sweat our assets in a much better way. So basically trying to see how we can use those capabilities.
So ACs, washing machines, TVs. I mean, so adjacent areas, right? So I mean, you can tell us, Mr. Gupta.
So I would like to not make any speculation here. As and when we are able to have a firm business plan, we will be definitely coming out and making a statement on that.
Now, I want to ask you about the laptop segment. That could be a potential area, right, where you'll start making some inroads. And I was looking at the top players over there. Some of them are coming up with their own manufacturing facilities, or they already have tie-ups. So how do you penetrate that? And I think you have some targets under the PLI scheme as well. So how do you get there? If you could tell us laptops as a percentage of your business, how does it scale up? Or give it an absolute number, a few hundred crores, how does it scale up? Laptops only.
So, Nigel, basically in our PLI scheme for IT hardware, other than laptops, there are other product categories also, like servers and all-in-one computers. And we are discussing with certain clients. Till now, we have not been able to make any substantial progress in that. But definitely, there are certain discussions. I think in coming quarters, we should be able to have some kind of breakthrough on that. And maybe we'll be able to utilize that IT PLI also. So we are keeping our fingers crossed in certain discussions. Let them mature, then we'll be sharing the details.
So you'll have to target the top 5 or 6 players, right? Because they have around 83 to 85% of the market. So you're looking at penetrating and getting a contract from one of these players since they have 85% of the market, right, Mr. Gupta?
So again, I will not like to make any guess on that.
I'll tell you what is the issue, Mr. Gupta, because then if you don't penetrate with them, then how do you get to those numbers? But you're saying you have a plan, so we'll have to take it at that for now. Say, if you want to give us a number on laptops, then it'll be helpful. You know, your growth has been phenomenal in the last few years, but now the street is looking ahead that in the next 3-4 years, what could it be like? So that's why I'm asking you about laptops, which could be another, revenue spinner for you.
So definitely, Nigel, when we enrolled into this IT hardware PLI, definitely this laptop was one big thing which is still there on that horizon. In fact, other than laptops, as I told you, there are certain other product categories also. We are working on that. So give us some time. We'll be making a statement of that in coming time.
Going to be what, next quarter, sir? What's the time frame we can work with on more clarity basically on how you're looking to build up on the IT hardware PLI, the categories, the investments, and then of course, what you're expecting there. When can we get some more clarity on this IT hardware?
Maybe next quarter we should be able to make some statement on that.
And a completely new category also.
So by the way, so the new category that you were speaking about, is it over and above IT hardware?
Yes. So we are talking about some other categories as well. So it is not only the IT hardware. There are certain other allied product categories that we are working on. And as and when we are able to finalize and make a certain business case, we should be making a release on that, press release on that.
Okay. All right. We will leave it on that note. Mr. Gupta, good talking to you. Thanks very much. And we're looking forward to the future conversations to get more perspective on some of the newer lines of business that you would be looking at. Moving on now, we're focusing on BLS International Services, the biggest global players in visa application outsourcing. The stock has had a good run in the last 1 year. The gain is almost 90%. Talk about business momentum in the outlook. We have with us Shikhar Agarwal, Joint MD, BLS International Services. Shikhar, great to have you with us. I want to actually start not with Visa, we'll get to Visa in just a bit, but with your smaller business, which is digital businesses. And it's very interesting to note that you're looking at more tie-ups with banks and looking at offering last mile banking services. Give us some idea of the strategy here, the plan and the scale up. By the end of this year, by how much do you want to scale up this business? And how do the commercials stack up here in terms of profitability for this side of the business?
See, if you see BLS services, the profitability that we did last year, we achieved a bit of 46 crores, which was a 50% growth compared to the previous year. So definitely there has been a major growth in BLS services. The transaction volume, GTV, that we count, we were doing 60,000 crore, in 2023. Last year we closed at 72,000 crore. We are now in 21,000 BC points for different banks across India. We have 100,000 touch points across the length and breadth of the country. We are tying up with more banks, more private sector banks. We've started working for HDFC, Access, different other private sector banks. So we expect major growth to come in from BLS services within this year and next few years.
Okay. In terms of a percentage of the business, how much do you see it scaling up to? 20%, 30% in FY25 and FY26? And what would the margin of this business be compared to the visa services business?
See, this business has already scaled up 50% compared to last year. So we grew. So we definitely, we expect organically, definitely we can grow at least more than 20%. But definitely growth, we want to maintain the momentum, whatever we have achieved in the last few years. We are eyeing some acquisitions as well. We are working with different states right now, Karnataka, UP, Rajasthan. We've already added a few more states, this year. We've started some Aadhaar work also with UIDI. So definitely I expect more increment in revenue and profitability to continue this year. Margins in this business right now are lesser than the visa business. We do EBITDA margins of around 15%, whereas in the visa business, we do EBITDA margins of upwards of 21%. So definitely, as we have increased the margins in the visa business, we expect the margins also in this business as we mature as a company. This is a very new company. We started only 4-5 years back. So we expect margins to increase as we start more services from the existing centers.
Okay, now I'm coming to the bread and butter, the bulk business, Shikhar, and the world seems to be traveling like never before. You look at airports, you look at everybody trying to book a foreign holiday, look at load factors across airlines. So tell us, for this year, you should be doing a lot better than last year, right? Because FY23 versus 24, I think last year top line growth was just about 10-11%. So given that there's so much buoyancy in the global travel space, what should be an expected reasonable top-line growth that you'll look at this year?
See, first of all, if you see last year, 2024, the financial year that we ended, we grew 60% at EBITDA level. So we did 325 crores of EBITDA compared to around 200 odd crores of EBITDA that we did the previous year. So there has been a massive growth, compared to last year. Definitely, the revenue growth has been a little less because, we changed certain structures across the world. Some of the partners, the local FMC partners that we were operating with, we took over those countries. So that is the reason, there was a less 10% increase only revenue growth. But if you see EBITDA has grown by 60%. The margins have also grown. We did 21% of EBITDA margins in the visa business. We expect to grow further, at least by 300-400 basis points. That we expect to grow more in the visa business this year. Definitely, now if you see after COVID that happened 2 years back, travel has become new normal now. People are not only traveling one time in a year, people are traveling multiple times in a year. Everyone, all are traveling to newer geographies, nearby countries to far off countries. So definitely there has been a major surge in applications across the world. But, we also operate under a limit by the governments that we work with. We have to work according to their capacity. So we have revamped our offices across the world. We recently launched new joint visa center in Delhi. We're going to launch a new center in Mumbai. We have launched a new center in London. We are expanding our capacities. We have won new contracts with a lot of governments, like we recently rolled Portugal government contract in Morocco. We won Slovakia, Global, Italy, Hungary, Czech Republic, Portugal, so Poland. So many new contracts we've been winning. We renewed our existing contracts. So I feel that we are on a good growth trajectory. Whatever numbers we've achieved last year, we expect to maintain that and grow further.
Okay, you said 300 basis points expansion. That's visa business EBITDA margin expansion, right? What was 21 should become around 24 this year. That's what you're saying?
I mean, the target is that upwards of 300 basis point visa EBITDA expansion that we are seeing. We have seen a major surge in revenue in the applications, whereas cost has become rationalized. As we add more contracts, we can share the offices across the world. So economies of scale will kick in. And that is the reason, that we have been talking about from the last 2-3 years, that as in when we win new contracts, we will add into our existing centers. So definitely margins will improve. And that is the same thing we are expecting this year.
Okay, all right. Hi, Shikhar. Good to see you on the show. And it's been a while since we spoke as well. Tell us about that inorganic growth. You briefly mentioned at the start of this interview and you just, sneaked it in and it went past. So what's the size of the acquisition you're looking at? And should we hear about something in this quarter, in the coming quarter? Quantum and timing?
See, the last acquisition in BLS International that we announced of iData, there is a multi-jurisdiction transaction. So there were some pending approvals. Most of them have come in. We expect to complete this transaction most probably within this month. That will be the first major acquisition. We are acquiring the fourth largest regional player, iData, which is working for German government and the Italian government. So we will be having 50% upwards of market share, for the visa business for Germany now globally. And now, as we go, our cash has definitely increased. We will be utilizing this cash in this acquisition. We are also eyeing other acquisitions across the world. Maybe within a few quarters, next 2 quarters, we will be announcing that as well in BLS International and in BLS e-services as well. The money that we raised with IPO, that IPO happened only 2-3 months, 3-4 months back. The money that we have raised, we are seriously looking at acquisitions in BLS e-services, wherein we aim to finalize those acquisitions also within the next few quarters.
Okay, so more inorganic growth ahead. Looking forward to hearing more on it and more conversations around it as well. Shikhar, good luck with those plans. Thanks for joining in today. All right, with that, let's move back to the market. The market, which is gradually inching higher, trying to build on the opening green that we had. 70 points up on the Nifty right now. Mid-cap index doing a shade better. Let's go back to Mitesh. Mitesh, so it's a more steady morning. What about calls now? Any new ideas?
Yeah. It's a good morning, actually. It's holding out well at just around the 23,400 mark. Berger Paints has come on the radar. It's been rising for the last few days. That's a buy with a stop at 495 and a target of 520 can be looked at. And Godrej Properties is just making a fresh swing high. Buy here with a stop at 2960 and a target of around 3100.
Okay, all right, Mitesh, thanks very much for that. So those are some trading ideas coming through. We'll take a break. We are back. Manisha will join in with the focus on commodity markets. Stay tuned.
Welcome back. Some interesting moves in the market. Thought of pointing them out to you. Paytm is surging, 7.5% higher on Paytm. There is a Sobha that's been higher, right from the opening levels, 6.5% up over there. And Dilip Buildcon. Actually, some stocks are picking up some life now. Dilip Buildcon is almost 10% higher. There is Paras Defense, which is about 5.5% up. So the mid-cap and the small-cap arena continues to buzz around. That's the short message, short point. Mid-cap index up about 0.6% as of now. Well, that's the equity space. Let's go across to Manisha and figure out what's the latest in the commodity markets. She's with us in the studio now. Manisha, you're looking at oil?
I am, yes, and that's because there is some pressure coming in for the prices. As was anticipated, this is a knee-jerk reaction after the US Fed meeting there. And 1 rate cut this year and 4 in the next year is what the street is looking at. But it also is about the inflation data, which is lesser than what the street was anticipating. And that, in some sense, is a supportive way there. And is the reason you haven't seen a complete crash in the prices, but just about 0.25% of a decline coming in there. But there are other various factors which are weighing on crude oil prices right now. One, of course, is the ongoing ceasefire talks in Gaza. I mean, we've been hearing about that for the last 3 months now, but nothing has happened. But the point being that both sides are talking on that. The other is the US inventories, where we have seen an increase instead of a decline as the street was anticipating, and that too by 3.7 million barrels. But not just for crude. When you look at gasoline and distillate stocks, there has been a build-up in inventories in that as well, and that's weighing on to markets. The other is the IEA data and report that came in yesterday, which has cut demand growth forecast for this year to less than 1 million barrels per day. Remember, this is quite contrary to OPEC putting it out to 2.2 million barrels per day. So that is the range that we're looking at, but there is demand growth nonetheless for this year as well, and that in some sense could be supportive going forward. Interesting reports then, and Morgan Stanley for one says that by the third quarter, the global deficit estimate is at 1.2 million, which will take the prices to 86 on the higher side within the third quarter. There also is a report from Citi which says that there is deficit concerns for the near term, but for the next year, they've put the Brent crude price forecast to $60 a barrel barrel as well. So it's all over the place the way that you see the crude oil prices and the fundamentals working in. But very interestingly, the EIA also has come out with a detailed report for India, which is the third largest importer and consumer in the world. And EIA says that they are looking at stronger demand going forward. India actually could lead the demand globally as we get into the second half of this year and for 2025 as well. The number that they're putting is in sense of 1.3 million barrels per day until 2030. So if I can get you the India demand chart in front of you, where we stand right now, that was in 2023, we were at 5.4 million barrels per day. Now EIA says that by 2030, we will be looking at a higher demand at around 6.7 million barrels per day. So when it comes to India, the demand is only going higher until 2030 there, even as EIA talks about world demand peaking in 2029. If you look at the refining capacity, well, there as well, the number is almost doubling there. Also, India demand contribution, most of it comes in from diesel and petrol to the tune of 38 and 25%. And with urbanization, infrastructure, more cars being bought and population increase, that number is also expected to grow. EIA actually says that there is expected a 40% increase in India's car fleet by 2030. So huge numbers coming in, and the fact that the Indian crude oil demand is not going away in a jiffy.
All right. Manager, thanks very much for that. So that's oil demand peak in 2029, but growing as of now. Small, very low single-digit growth, but growing. Manager, thanks very much. Well, Sobha is the next is a stock we are focusing on. Sonal is here with details on this one. Sonal.
Thank you for that. Sobha is in focus because they've announced a plan to raise funds, and this is via rights issue to the tune of 2,000 crore rupees. The board approved that rights issue yesterday. The issue price is set at 1,651 rupees a share. This was 20% lower than yesterday's closing market price as well. Now, in terms of more details, the proposed equity issuance is of 12.1 million shares, and this could lead to a post-issue equity dilution of 11.3%. In terms of the payment, there will be a payment on application which will be around 825.5 rupees a share, which is half the amount, and the rest can be paid in 2 installments as per the company and not late more than that. The process, according to the company, should be completed on or before 31st December 2025, and the entitlement ratio here is 6:47. The street believes that this money could be used for growth capital. They are talking about a lot of expansions as well, and that's why this positive reaction on the stock today.
Okay, all right, got it. Thanks, Sonal, for that. Sobha definitely in focus and in green. Now, let's go across to Vivek, because that L&T Finance block trade did happen. Vivek, run us through the details.
Well, that's right. The block did happen, and along with that, it also appears as though the overhang which was there has also now passed by. So, along the lines of what we, reported in the morning, BC affiliates, that is Bain Capital affiliates, which is BC Asia Investment, BC Asia Growth, as well as BNP Paribas. All of these funds likely sold in today's block deal. Remember, it happened in the block window itself. Around 3.5% of the total equity changed hands. So all three of these holders in the company now no longer have any stake. So it's a clean out trade, and which is why we say that the overhang is now done. The deal size, was slightly above the range of 1,500 crores. So now it is the overhang is done, and which is why you're seeing the stock trade in the green in today's session.
Well, nearly 4.5% higher right now. Vivek, thank you very much for that. Well, it's time for a quick commercial break here. On the other side, our special segment, it's the economy. Lata will get chatting with Jahangir Aziz of JP Morgan as the Fed holds rates and inflation cools down. Not just here, there in the US, but here in India as well. So all of that coming up in this special conversation.